Welcome to the deep dive.
Yeah.
We're here to cut through the noise on some pretty complex emerging tech. And today, we're tackling Virtual's protocol. That's the project behind the virtual token.
Right, and this one's fascinating because it's right at that, intersection. AI agents meet decentralized finance.
It's trying to build basically the economic plumbing for, well, digital workers that run themselves.
Yeah, the sources we looked at, white papers, tech guides, market analysis, right up to this week, they all start from this really big idea.
Which is?
That AI agents are pretty much poised to take over huge chunks of the human workforce.
A huge claim.
It is. And if that happens, these agents, they can't exactly use Venmo or Swift, right?
Right. Need something different.
They need to trade, pay, do business seamlessly, permissionlessly, autonomously. And blockchain is, well, the obvious candidate for that kind of infrastructure.
So Virtual is meant to be the money that holds this whole new AI economy together.
That's the design, yeah. The central currency.
Okay, so we've looked at everything up to October 17th, 2025. Our mission today is threefold. How does this platform really work technically? Why is that virtual token so critical? And what's behind this price tug of war we're seeing right now?
Good plan.
Let's start with the vision, because it's ambitious is putting it mildly.
Definitely. So the problem they're tackling is, well, how AI is owned and funded today.
Very centralized, right? Big tech companies.
Exactly. It's mostly large corporations calling the shots, funding the research, owning the models. Makes it really hard for regular folks or smaller devs to get involved in the value creation.
Right. So here's the aha moment for Virtuals, I think. Don't just think DeFi. Think like the Shopify for AI agents.
That's a great way to put it. It's like an incubator and a marketplace. An AI agent store plus an AI agent stock exchange almost.
Okay.
They're building what they actually call a society of productive digital workers.
Okay.
These AIs are designed to offer services, make things, and basically do business with us or with each other, all recorded on the blockchain.
So if the agents are the workers, how do I invest in them? Buy stock in their output.
Tokenization, that's the key. Every single AI agent launched gets its own token, and an agent token.
Got it. So that represents a share.
Precisely. The vision is essentially an AI agent Wall Street, but democratized. Anyone can buy these agent tokens, co-own a piece of an agent.
And share in its revenue,
Oh, exactly. Your interests are aligned directly with the agent's performance. It completely bypasses the old venture capital or corporate funding routes for AI. It's a really powerful idea.
And this isn't just theoretical, right? You mentioned there are actual agents running now.
Yeah, absolutely. To make it less abstract, think about Igbet.
The crypto intelligence one?
That's the one, sells trading data. Or there's Vader AI, basically an autonomous hedge fund in a box.
Wow, okay.
And maybe the weirdest one is Luna. An AI influencer, a vocalist, actually has songs on Spotify generating revenue.
Seriously. An AI singer on Spotify.
Yep. Shows the range they're aiming for. These are like tiny autonomous companies designed to earn income.
Okay, that makes it much clearer. But wait, if these things are truly autonomous, making their own decisions, spending money, how do they talk to each other reliably?
Excellent question. And how do we stop them becoming just, isolated digital islands?
Yeah, it's one thing to say an AI can use crypto, another to build the roads and the traffic rules for a whole economy of them.
Right. And that brings us to the tech foundation, the architecture. It's built on three key pillars.
Okay, pillar one.
Pillar one, the Agent Commerce Protocol, ACP. This is really the core innovation here.
Okay, what does it do?
It's a new open standard for secure, verifiable, and efficient commerce between these autonomous agents.
An open standard so anyone can use it.
That's the goal. The sources really emphasize this. Without something like ACP, every agent developer might build their own communication method. It'd be chaos, like every website speaking a different language.
Right, no interoperability.
Exactly. ACP provides that universal language of trade.
Yep.
And crucially, it makes the interactions verifiable on-chain.
Why is verification so important there?
Because they're autonomous. You need proof. Proof the transaction was legit, sent correctly, followed the rules, without a human double-checking. ACP gives you that trustless audit trail. Centralized APIs just can't do that.
Got it. Pillar two.
Pillar two is the tokenization platform. This is the nuts and bolts for launching those agent tokens we talked about, the shares, and also setting up their initial trading pools or liquidity.
The Launchpad part.
Kinda, yeah. It ensures the incentives are aligned right from the start when a new agent goes live.
Okay. And pillar three, Sounds futuristic. Game framework.
Ah, yeah. Generative autonomous multimodal entities. GAME. This is basically the agent's brain.
The decision-making part.
Exactly. It's a modular engine, uses foundation AI models. It looks at the context, its goals, the tool it has access to, and then figures out the smart, autonomous action to take, whether that's interacting with a web API or doing something in a game or metaverse.
Interesting. And where does all this run? Which blockchain?
They're using a multi-chain approach. Smart, really. Primarily on Base.
Ethereum layer 2.
Yep. Faster, cheaper transactions, but still tapping into Ethereum security. They also use Solana.
Look, speed, I assume.
You got it. Solana's known for high throughput, which is great for agents making lots of tiny, quick transactions.
Okay, let's circle back to the tokens for the agents themselves. You said ERC-20s for the shares, but there was something else. ERC-6551.
Right. This is super interesting tech. ERC-6551 allows an NFT, think of it as the agent's unique digital ID card, to have its own wallet address, its own bank account, basically.
So the agent itself, not a human owner, controls the wallet.
Exactly. It's called a token-bound account. The agent, through its NFT identity, can hold assets, sign transactions, interact with other contracts, all on its own.
Without needing me to click approve.
Precisely. That's what enables true digital autonomy and commerce at scale. It's a pretty big deal for this whole space.
Okay, that makes sense. Which leads us nicely into the actual engine room, the virtual token, the fuel for this whole system.
The monetary backbone.
Quick facts first. Total supply, hard capped. 1 billion tokens. No more can ever be made.
Right. Built-in scarcity from day one. Prevents inflation down the line.
And circulating supply. The sources put it around 65% right now. About 652 million tokens out there as of mid-October 2025.
Correct. So there's scarcity, but the real driver is utility. What makes people need the token?
And the docs point to 3 main things.
3 key mechanisms, yeah. Driving demand, locking up supply,
First one.
agent creation. You want to launch a new AI agent on virtuals. You, the developer, have to pay up
How much?
100 virtual tokens. And critically, they are locked permanently when you deploy the agents.
Permanently. Wow. Okay, so that directly reduces the circulating supply every single time a new agent is born.
Exactly. It's a cost, but also ensures people are serious about the agents they launch. No spamming bots, ideally.
Okay, makes sense. Second mechanism.
Liquidity pairing. This is crucial for the token's deflationary-like pressure. When a new agent token is created, shares in Vader AI or whatever its initial trading pool must be paired with virtual.
So you need virtual to even create the market for the agent's shares.
Correct. Virtual is the mandatory base pair. This locks up significant amounts of virtual in all these different agent liquidity pools across the platform.
Got it. Locked liquidity. And the third driver.
Transactional currency and payments. Virtual is the main currency for routing trades within the ecosystem. If you want to swap tokens for one agent for tokens of another, your trade probably goes through virtual.
Like a reserve currency for the platform?
Kind of, yeah. But also, the agents themselves use virtual to pay for things autonomously.
Like what?
Like accessing data from another agent, using an external API, running a computation. The sources call it per inference payments. Micro payments in virtual every time the agent needs to think or use a tool via its game framework.
So virtual is literally the gas the agents run on.
You could say that, yeah. Constant transactional demand.
Okay, so this creates a value loop, right? If an agent like ACE-B8 actually makes money.
Right, say it charges fees for its crypto data.
That income.
Yeah.
What happens to it? Does it buy back virtual?
Not virtual directly. It's used by the protocol to buy back and burn that agent's specific agent tokens, the shares.
Ah, okay. So it makes the shares in ACE-B8 scarcer.
Exactly. Which theoretically should increase the value for anyone holding those ACE-B tokens, the co-owners.
So successful agents reward their shareholders directly through deflation of their own token.
Mm-hmm. And the more productive the whole ecosystem is, the more valuable the underlying platform, and by extension virtual, becomes because it's needed for everything.
Makes sense. Okay, so that's the theory. Powerful stuff. But now, let's shift gears. The messy reality of the market. October 17th, 2025.
Right. The tug of war, as the analysts are calling it. Strong fundamentals clashing with, well, market jitters.
Let's start with the bulls. What's pushing the price up, or trying to?
Well, first, agent adoption is growing. Sources show 20-30% quarter-over-quarter growth in new agents during Q3.
So more virtual getting locked up constantly.
Correct. Increasing scarcity. And then there was the big news just yesterday, October 16th.
The Robinhood listing.
Huge accessibility boost. Opens the door to potentially 23 million users.
Did it have an immediate impact?
Oh yeah. The data shows a 56% volume spike right after the listing. Shows there's definitely some retail interest bubbling under the surface.
And performance-wise, it's been a roller coaster, hasn't it?
Totally. Incredible 678% annual return if you look back a year. But, and this is a big but, it's also down 57% year to date. High growth, high volatility, classic emerging tech play.
Okay, so growth in agents, new exchange listing. Sounds good. But what are the bears pointing to? What are the headwinds?
There are some serious ones. The biggest red flag, according to several analyses, is user engagement. It's cratering.
How bad is it?
Daily active wallets peaked around 10,000 in Q3, down to just 1,500.
Oof, that's an 85% drop. That's significant.
It's huge. It suggests that while devs might be building agents, actual users aren't sticking around or engaging deeply right now. That's a major concern for long-term value.
So the infrastructure might be cool, but maybe nobody's actually using it consistently yet.
That's the fear, yeah. Plus, the timing of the Robinhood listing wasn't great, macro-wise.
How so?
The broader crypto market sentiment is terrible. The fear and greed index is way down at 28. Extreme caution territory. People are nervous.
Okay. And technically, the price charts.
Not looking amazing either. The price is stuck below key moving averages. The 30-day EMA around $1, the longer-term 200-day SMA at $100.36. Those are acting as resistance.
And what about the big holders? The whales?
Also a bit bearish. On-chain data shows they've been selling off gradually. Holdings down about 2.4 million tokens since May. Suggests some smart money is maybe taking profits or de-risking.
Okay, so for listeners trying to make sense of the charts, what are the key signals to watch?
Two things jump out from the technical analysis. First, the RSI, the Relative Strength Index. It's low, around 35.98.
Meaning?
Technically means it's getting into oversold territory. Suggests a bounce could happen, especially if the price holds above the key support level around 75 cents.
Okay, so watch $80.75 support and RSI. What else?
Look at the type of trading volume, specifically the spot versus derivatives ratio.
Why does that matter?
Right now it's low, about 0.31. Means lots of futures speculation relative to people actually buying the token to hold. If that ratio climbs above, say, 0.5 and stays there,
that would suggest more real buying, organic demand.
Exactly. More people buying virtual for exposure or utility, not just betting on price swings. That would be a much healthier sign.
Got it. Okay, so let's try and wrap this up, putting all the pieces together.
Virtual's protocol has definitely built something impressive. That Shopify for AI agents idea, its powerful infrastructure, simplifies agent creation, enables this co-ownership model.
But it's a big but.
Its success really hangs on reversing that scary drop in user engagement. And it needs sustained agent deployment, real agents doing real things to fight back against this weak crypto market.
If the platform just sits there, even with great tech, the tokenomics won't save it. Needs activity.
And there's the risk about agent quality too, right? Yeah, analysts are definitely worried about that. The AI meme coin problem. Lots of agents launched perhaps just for hype without a real plan to generate revenue.
So the platform could get flooded with junk bots.
It's a real risk, which makes their governance model absolutely critical.
The agent sub-DAO.
Right. The plan is for validators and liquidity providers to eventually have oversight, approve only high-quality agents, but that's still being developed. It's not fully live yet.
So the transition from a sort of centralized launchpad now to a truly decentralized, community-governed AI society, that's the real test.
Absolutely. How quickly and effectively they make that transition. That will likely determine the long-term value way more than any short-term price chart.
Okay, so final thought for you, our listener, to chew on. Given everything we've discussed, the tech, the tokens, the market forces, what do you see as the single biggest hurdle, the biggest challenge in actually building a functioning Wall Street for AI agents? Lots to think about there.